The end of the dollar being pegged to crude oil and its status as the global reserve currency is confirmed, which has significant repercussions. In the 1970s, it was Saudi Arabia's peg of crude oil to the dollar that cemented its position as the global reserve. This comes at a bad time as the Biden administration drained the strategic petroleum reserve to low levels to tackle inflation, putting the U.S. in a position where it may be forced to pay for crude oil in a different currency. The U.S. government is also facing a massive issue with the debt ceiling, and the Treasury is now turning to emergency measures to keep the government open. Meanwhile, Saudi Arabia has stated that they are open to settling in different currencies, marking the potential end to the dollar's dominance. Discussions on settling trade in different currencies, including the US dollar, the euro, or the Saudi riyal, are not being ruled out to improve global trade. Saudi Arabia has announced that it is open to settling its trade deals in currencies other than the US dollar, marking a potential end to the dollar's dominance. For decades, it maintained a currency peg to the dollar and has relied on pricing its crude exports in US currency and helped establish the US dollar as the global reserve currency. The announcement to open up to other forms of currency is aimed at strengthening its relationships with trade partners, including China. The breaking of the Petro Dollar system, where crude oil is traded in dollars, could lead to a decline in the dollar's dominance as a global reserve currency. During Chinese President Xi Jinping's visit to Riyadh last year, the two countries agreed to enhance their coordination on energy policy and exploration, with China expressing its interest to purchase more oil from the Middle East and settle the trade in yuan. Be sure to like and subscribe for more content. China, as a major oil importer, has expressed a desire for oil trade to be settled in the Chinese yuan. If countries like Saudi Arabia start accepting yuan for oil, they may need to accumulate reserves in yuan, which could result in them having to choose between holding reserves in yuan or the US dollar. The reason for countries wanting to trade in their own currency is often because they do not want to be impacted by fluctuations in the value of the dollar. The chart shows the value of the US dollar over the past 43 years, highlighting instances where the dollar has become too strong. The rising value of the US dollar, which recently increased but has now declined, puts pressure on the global trade and financial systems. When the dollar is too high, it indicates a global shortage of dollars, making it more expensive for countries such as China to purchase oil from Saudi Arabia. To mitigate this stress, people may look for alternatives to using the US dollar in global trade. If the US were able to provide enough dollars, there would not be a need for major changes in the status of the US dollar as a global reserve currency. Countries like China and the US have strategic relationships and the potential for developing similar relationships with other countries like Europe, who are open to using different currencies in trade. This shift away from the US dollar does not occur abruptly, but happens gradually over time. It is a crucial time for the US, as the country has depleted its strategic petroleum reserve to low levels in an effort to reduce inflation. But the strategy has been somewhat successful as inflation declines but remains high. In the event that the US needs crude oil, it does not have the necessary reserves and would have to pay a high price. As for the recent market behavior, the reason for a lack of big selling is that the machines involved in trading are not seeing it as a significant move. The slower algorithm in the CTA timer report can provide insight into how the machines are trading the markets. There is a possibility that a move away from the US dollar could put the country in a difficult position, where it may have to pay high prices for commodities. Credit Suisse refers to Zoltan Pozsar, who is considered a leading expert on the global monetary system. In the report, Pozsar writes about oil, gold, and the Strategic Petroleum Reserve. President Biden had stated that he plans to fill the SPR when oil prices reach $75 per barrel. This announcement was met with disbelief as many people were shocked that oil prices could drop to that level. Currently, oil prices are in the low 80s, and the general belief is that the global energy shortage means oil prices will not fall to $75 or below and stay there long enough to refill the SPR, which could be a major issue if the world were to go to war and need the reserve for emergency purposes. Pozsar suggests that Russian oil could be part of the strategy to refill the SPR. Russian crude already sells at a $30 discount relative to Brent, and China and India are known to be big purchasers of Russian crude. The U.S. is in a critical situation as its strategic petroleum reserve has been depleted. Despite efforts to reduce inflation, it remains too high. This puts the U.S. in a predicament where it may need to pay any price to get energy and crude oil, as it doesn't have enough reserves. Zoltan suggests that the situation could lead to a massive repricing of crude oil into gold, which would add to the narrative that the dollar's days are numbered. Zoltan cites measures between the US and Russia, where Russia could revalue oil and make countries pay in gold. This would effectively make the US pay in gold for Russian oil and offer the US a bargain by offering 2 barrels of oil for a gram of gold, which would double the value of Russia's gold reserves. Before the war, Russia has already made moves towards this by getting rid of their US currency reserves and increase their gold holdings. The current state of monetary and fiscal decisions is dominated by state intervention and a year of unpredictable macro scenarios. The country has a vested interest in seeing gold replace the dollar as the dominant currency used to trade crude oil, which it has a large quantity of. In addition, the U.S. Treasury Department also faces a problem with the debt ceiling. The Treasury has been forced to tap into retirement funds to prevent breaching the debt limit. Meanwhile, the Treasury is adjusting investments in 2 pension funds for retirees in order to keep making federal payments, despite being unable to raise the debt limit. Treasury Secretary Janet Yellen informed leaders of both parties about this plan through a letter. This may cause political tension and result in a government shutdown, which has happened in the past due to questions about the U.S. ability to pay its debts. In the near future, we may expect a response from Fed Chairman Jerome Powell. The expected statement is that there is no need to worry about any form of default, and that the payments on all debts will be made. This is considered to be more of a political move rather than a financial one. The question then arises whether if a deal is made on the debt ceiling, will it result in the dollar going up or down? There is no clear correlation between the two as seen in the past, where the Treasury General account has come down, but the dollar did not make a significant move. The dollar did, however, rise after the TA went down. This lack of correlation is due to the fact that Republicans want to cut spending while Democrats don't, and the debate will continue until one side yields. This is not the first time that such measures have been resorted to by the Treasury, with the agency having used such measures more than a dozen times since 1985. According to Treasury Secretary Janet Yellen, the debt issue and suspension period began on Thursday, with no new T-bills being issued until June 5th, unless a deal is made. The Treasury will also stop additional investments credited to the fund and redeem a portion of the investments held by it. Although there has not been a major debt default, global political events, such as the current situation with Saudi Arabia, may cause people around the world to become uneasy about this and further move away from the dollar. It's very unlikely that the United States will default on its obligations, which leads investors to believe they will raise the debt ceiling. This is an indirect admission that the U.S. will inflate its way out of debt. As a result, rival countries are prioritizing the accumulation of precious metals as seen in previous years. Be sure to subscribe, and thanks for watching.